Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation. This will be part 2 of this presentation, so make sure that you've seen part 1, and we're going to continue on from that point. We're going to have a situation where we have a parent-subsidiary relationship. We're going to be doing a consolidation for them. The parent has a controlling interest over 51%, but not 100%. Therefore, we will have to account for a non-controlling interest as well. We're going to have a situation that we're focusing in on where the parent purchases the bonds of the subsidiary, but weren't issued the bonds directly from the subsidiary, but rather purchased them from a third party, and they purchased them from the third party at a discount. So get ready to account with Advanced Financial Accounting. Here we are in our OneNote practice problem. So we're on this tab, we're on the 835 tab. So I'm gonna break that down, and if you go all the way to the top of the tab, we're gonna be quite a ways down within the tab. The tab name will then be that 835 Consolidation NCI P purchases S bonds from third party at discount. And then we're gonna scroll all the way down. We're gonna go all the way down to the current component we are at, which is going to be taking a look at some of the actual journal entries. So this is where we're at here. We're going to be considering the effect of these intercompany bonds, and we want to think about them in terms of a journal entry component so that we can use that to do our consolidation entries and elimination entries. So we want to think about the P interest income kind of journal entry and the S interest expense. So here's going to be our data that we had with regards to the bonds. You recall that S issued bond on January 1st, 2000X1. There was no problem here. They didn't originally issue it to P, so they just issued bonds, no problem. Face amount, $190,000, interest, 8%, and then the year's 10, then they issued at the premium of the 104. So they're going to be recording information on their side with regards to this original issue amount. But we're really only concerned with the ones that got purchased by P from a third party now, which means P purchased bonds from one of the original owners in 2000X2, but they only purchased 76,000 of the 90. So we're really concerned with the 76,000 of the 90 with regards to both sides of this transaction. What would the journal entry look like with regards to 76,000 of the 190 bonds? They purchased it for that amount, and then they purchased it for $74,480, meaning they purchased it in their eyes as basically a discount on their side of things. So what would they have recorded with regards to like the intercompany kind of transfer activity that we would have? Now, we've seen this in the past, but it won't mirror as nicely here because we have this third party kind of thing messing it up. So on P's side, what would happen? Well, we're going to say that they would record cash. I'm going to, as part of the transaction, we're not going to post this. We're just going to think about the journal entry that would take place. I'm trying to pull up the trusty calculator as I'm talking here. So here's going to be the trusty calculator. We're going to be taking, I'm not going to take the 190,000 times the, well, we're talking about P's side. P's the person that's going to be receiving the money. And then in S's side, again, we're not going to be talking about the 190. We're considering and concentrating on the 76. So on P, they have the bond, so they're going to get 76,000 as their portion times the 0.08. So that's going to be the 6,080. And then we have on P side the investment in the bonds. They got basically an asset on the books for the bonds. If we consider the accounts that would take place, we've got the investment in the bonds on P side of things for that 74,860 because they bought it at a discount. This needs to be going up to the amount of the face amount of the bonds, which was for the 76,000 at the end of the day. So then we're going to have this 190 investment in S bonds that we're going to be debiting, and we did the calculation for that down here, which was we figured out, the discount amount divided by the number of periods. So we've got the 190. So then the 680 and the 190 would give us then the interest income, which on our trial balance is going to be included in other income. So for P's, we have interest income of that 6,270, but that's basically intercompany activity. What about S's side of things, which issued the bond? Now remember, again, S issued 190 bonds, but we're only really thinking about the ones that are intercompany. We want to think about the journal entry, in journal entry format, what would be the amount related to the intercompany bonds at that 76,000? So how can we think about that? Well, we'd say, all right, well, cash would be going the other side of cash. Cash calculation would be the same. it would be a credit to cash. Cash would be going out from S of the 6,080. Same calculation as up top. The bond premium, we would like to see it mirroring what's happening down here with the discount, but it doesn't because, of course, P purchased it not from the original issuance of S, but from a third party, and that's what's kind of ugly and what about this, or kind of complicates things. So it's not ugly; it's nicely complicated, right? So that means that's what resulted in that gain that we're going to have to be dealing with. So what we need to think about on this side is the premium that's going to be amortized, but the premium that's going to be related to the 76,000, not the full 190,000 of the bond. So there's a couple ways you can kind of get to that. One way we can think about it is note we got this 40% we calculated before, and that was calculated as the 76,000 face amount that was intercompany divided by the total 190,000. That gives us the 40%. Now, if we multiply that times the normal premium, which is 760, so times 760, that's going to give us the 304, or kind of like the intercompany portion premium. So there's the 304 on the premium, which would be a debit. So then we're going to have the 6,080 minus the 304. We have the expense side of things, interest expense with relation to these intercompany bonds of the 5,776. So again, you can see these two don't mirror each other exactly. When we do the elimination entry, it's useful to see these or think about this in terms of basically journal entry format, and at least it is to me. And then we can go in here and pick up these numbers as we do our elimination entry process. Okay, so now let's think about our first journal entry, and we're going to do a similar kind of adjustment that we've done in the past for that first journal entry, so that when we're comparing basically the net income and the book value. So the starting point of our journal entry will typically be the net income of S and then the book value of S. So that typically will be the net income is recorded here on S's trial balance at the 89,000. So there's the 89,000. That's going to be our starting point that we will adjust in a nice even way for our journal entry. That's going to be the 89,000 times the 0.75 controlling interest is going to be the 66,750. Then we'll take that 89,000 times the 0.25, which of course is the 22,250. Then the second side of our journal entry will be the net asset side, which we can calculate as we did before in a prior presentation, assets minus liabilities or all of equity. Let's do that one time here fairly quickly. 68,800 plus 110,000 plus 32,000 plus 124,000 plus 47,000 plus 267,000 minus 61,000 minus 114,240 minus 11,000 minus 190,000 minus 4560. That's going to be the 268. We can find that same thing with all the blue accounts down below, or the equity side. Let's do that. That'll be fun. 40,000 plus 160,000 minus 21,000 plus. And then I'm just going to add net income instead of all the line items for it of the 89,000. 89,000. And that's going to be the 268 right there, which we will typically then break out on the same kind of way, 75, 25, controlling, non-controlling. So times the 0.75, 201,000. And then if we take that same 268,000 here times the 0.25, we get the 67,000. So that's going to be our starting point. Then we're going to make adjustments for it. I'm going to start with the adjustments up top. So we'll have the adjustment for the upstream reversal. That's going to be that 15,000. We've seen this before in a prior presentation for the same problem when we worked this kind of in a table format. We're going to use the similar kind of items here for this adjustment for the first journal entry. That was an inventory item. So we took it from this item here. You can go up and see how we calculated this one, but we got the 15,000 that we're going to be picking up for that adjustment. So then we're going to be breaking that out in the 7525. So we'll pick up that 15,000 times the 0.75. That's going to be the 11,250. That same 15,000 times the 0.25 will give us that 3,750. Next item, deferred gross profit down. This also having to do with the inventory item because this is a down transaction rather than an up transaction. Notice here we broke out 7525. Here we're just going to be taking the all of it going to P rather than breaking that out. That happened here in the yellow component. You can go back up and see where we pulled the data if you so choose to do so. We're picking up that 9,000 here, so 9,000 is going to be here, and so and again we're applying that all to P for the downstream transaction. Downstream meaning it went from parent to subsidiary. Then we have the consolidation of the constructive gain. So the constructive gain, you'll recall, we calculated down below. Where did the constructive gain go? Here it is. I made it green so I would see it, and then I couldn't see it. So that's going to be the constructive gain, which we had to calculate from the purchase that took place of the bonds from a third party that were intercompany bonds. That's the 3952. We divide that by the number of periods that were remaining. So we're basically dividing by the, going to allocate it over the periods, which is the 494. So the 494. So we're taking into account kind of like that current period allocation, that current period change of that 494, breaking that out between the 7525, which of course simply would be that 494 times the 0.75 at the 371 about rounded, 494 times the 0.25 being that 124 or about rounded. All right, then we're going to look at the other side of, or if we add those up, then of course, we're going to sum those up. So this was our starting point at the 89,000 in total, 89,000 plus the 15,000 minus the 9,000 minus the 494. That's going to be the 94,506. Similar transaction, if we were to sum these up and sum these up, this will be our adjusted. These would have been our starting journal entries. These will now be the starting journal entry amounts we will use down below shortly. Then we're going to take that same information and populate it into the bottom half here. So now we have the ending book value, basically the assets minus the liabilities here that we allocated out. We're going to take the same filler, the same stuff. So this same stuff is now going down here. So that's like the other side of the journal entry. And then we're just going to then add these up. So we're going to add these up and we get to our ending numbers down below, just the other side of the transaction. Once we have that, then we can do our first consolidation journal entry, which is always exciting. So we're going to go down to our first consolidation journal entry down here. I'm going to put the little reveal thing on it. So we'll do the reveal thing. So we're going to start with the first thing we see. We know this account needs to go to 0 at the end of the day. This account needs to go to 0 at the end of the day. We're first journal entries typically considering these accounts and basically the equity section of S that we will be dealing with. We've got P's trial balance. We've got S's trial balance. We've got the total of P and S trial balances added together here. This column will be the consolidation or elimination entries, which will include all entries up until this point and including the current entry we are working on. This will be our ending numbers for the consolidated trial balance after we have entered this. So this journal entry is already posted here. We'll see what took place as we look at it. So the first one is the investment in S. I'm going to get back to this number later. We're going to take it from the table. That's what the color means, but we'll get back to that soon. Then I'm going to take the common stock for S. So the common stock for S, this 40,000. We need to, in essence, remove this standard practice. This is a credit balance, so we're going to do the opposite thing to it, debiting it. Then we've got the retained earnings. This is a credit balance. We're going to do the opposite thing to it, debiting it. Then we've got the dividends. This is a debit balance. We're going to do the opposite thing to it, crediting it. So if we post these, the 40, the 160, and the 21, you can see them posted here already. So this is the P's books. This is S's books. This is the total. This is us, in essence, reversing with this journal entry S's numbers, bringing us back basically to P's numbers, these numbers matching, in essence, P's numbers over here. That's going to be the standard kind of practice. We typically then go to the income from S. Income from S at that 68,630. Oftentimes, we've been thinking about this in terms of allocating the 89,000 down here of the net income for S, which would typically be our journal entry, 89,000 times the 0.75 controlling interest. That would be the 66,750. That was what we would normally do. That's in our table, though. Here's our table. But then we adjusted it to that 68,630. That's okay. It'll reconcile because we're going to adjust one of these this other number down here. So that we're going to say, okay, I'm going to do that 68,630, but it'll still be okay and reconcile because we're adjusting like the other side too. So then we're going to do the non-controlling interest, which normally would be, we would take that is 89,000 times 0.25, and we get the 22,250, which would be right there. But we're going to adjust that once again using our table, the 25,877. That's why it's yellow. And that's going to throw us off, but it's okay because we're going to adjust this other one down here. So it'll like balance after we do both sides. So then we're going to go to the non-controlling interest in NA. The non-controlling interest in NA, that's usually assets minus liabilities, or the equity section times the controlling and non-controlling interest, this being the non-controlling interest. So usually it would be, let's just add up the equity section just for the fun of it. 40,000 plus 16,000 minus 21,000 plus, I'm just going to go to net income at the bottom, 89,000. That would be the 268. As we can see here, we typically break it out, the 75 and the 25. So if I was to say the 25 of the 268,000 times the 0.25, that's what we normally would use, the 67,000. We've adjusted it now to the 70,000. So there's the 70,000 credit. And then typically up top, if we go back up top, then this one is usually calculated as that same 268. I'm sorry, not the 268. The well, yeah, it's usually calculated 268,000 times 0.75. That's what would normally be here. But now we're changing it to this, the 202,880. So there we have that. Okay, so then our transaction, if we go on over here, we're going to say is the investment in the stocks. Investment in stock here doesn't take it down to 0 yet, but we're getting there. And then the common stock we already took a look at. The income from S is here. That takes us basically down to 0. It's a rounding error of $1, so we're okay with that, or I'm okay with that. I hope you're okay with that. And then the 25,877 is going to be in the non-controlling interest in the net income, the 25,877 here. And then the non-controlling interest in the net assets up above is going to be included in this line item. Then let's go on down to the next transaction. So we have the one we just did. So here's the one we just did. It's included in the consolidation entries to the right. So it's already included in there, as is the current one that we're going to be working on now. So we're going to be looking at the cost of goods sold. This is going to be including one of like the intercompany transfers of inventory transactions. Typically, when I think about this, I usually think about it as one of the entries is going to involve, we see these adjustments up top. This is the adjustment to like the equity section items, but that 15,000 is also going to be an adjustment for that we're gonna need for the cost of goods sold. So I usually think, okay, I'm going to pick up that 15,000, and then I'll pick up that 9,000 later. We'll pick up that at some point in the problem as well, with regards to some of these elimination entries with regards to the cost of goods sold and the revenue side of things. So we're going to credit that 15,000. So we're going to credit the 15,000, and then we have the investment in stock and the non-controlling interest, which are controlling and non-controlling interest balance sheet type of accounts that we're going to be allocating this to in accordance with the profit sharing, that being 75 and 25. So if we take that 15,000 times 0.75, we've got the 11,250, the 11,250 going to the investment in stock. So that's going to be included here. And then we've got that 15,000 times 0.25. That's going to be the 3,750. So we've got the cost of goods sold down below, calculating that 15,000. We've got the investment in stock up above. And then we have the non-controlling interest in A, which is going to be included in this item. Next transaction, we're going to scroll down. This is what we have done thus far. So this is included in the elimination column. We're going to be looking at this inventory transaction once again. And like I say, this second line item, the inventory, is coming from this. I would think of it coming from the same table. That other 9,000 is going to be an effect on inventory. And just to you want to kind of think this through to understand it, but just in terms of, the routine, I would think about the routine of that basically being a credit to inventory in this next transaction. So the next transaction, I'm going to say, okay, I got to eliminate the revenue and then deal with the inventory and then the cost of goods sold. So I'm going to say, all right, the revenue is going to be reversed for the 69,000. The $69,000 is going to be any intercompany revenue that took place in the current time period. So the intercompany sale was this transaction. So you can go back up top and take a look at it. I'm pulling the piece that we have calculated. So this is the current year item. So this is the current year activity. We had that $69,000. It was an intercompany $69,000 sale that took place. So we have to reverse it. So we're going to reverse that amount. Then the other side is going to be that $9,000. So that $9,000, that's coming from our worksheet that we discussed up top. That's going to be this item. These are the two items in our first journal entry type worksheet that was related to the inventory transactions, the intercompany transfers of inventory. So then that's going to be that item. And then lastly, we're going to have the cost of goods sold being the difference. So the cost of goods sold, $69,000 minus the $9,000, bringing us to that $60,000. So this is going to be included in the revenue. So revenue line is including that $69,000, bringing it down. The inventory up top, then inventory includes that decrease of the $9,000, and then of course the cost of the goods sold, the $75,000 is including the $60,000 decrease there. Next transaction, we have what we've done thus far up top in terms of, and these items will be posted into this middle column. And now we're going to be considering a transaction related to the bonds. It's kind of like what we've been waiting for here. We're going to add the reveal item and then consider our bond activities. So if we take a look at P and S, we're looking for those intercompany bonds. So we know that we're going to have kind of balance sheet accounts and income statement accounts. We're going to have to combine these together a bit. However, instead of kind of breaking out the balance sheet and income statement components, not as easy to do that given the fact that the bonds were purchased from like a third party this time, instead of just one company issuing the bonds to another. So we've got some of these intercompany bonds, the bonds payable, because S was the original initiator of the bonds, the 190,000 bonds that were initiated, and then P purchased some of them from a third party. So we got some of these payables that are going to have to go off the book related to the bonds. Then some of the premiums down here are going to have to go off the books. Not all of them, but only the ones that are related to the intercompany components. Then, of course, we're going to have the investment in S bonds. That's going to have to come off the books because these are the ones that P purchased not from S, but from somebody else, but they were S's bonds. So we're going to have to take those off the books because those are intercompany transactions for sure. And then down below, we're going to have interest income and interest expense that we will have to be dealing with this as well. And then there will also be an effect on the investment in the S stock and the non-controlling interest due to this kind of intercompany gain item that happened, this purchase from the third party. So let's think through this. We're going to say, all right, we've got the bonds payable. Bonds payable, we know that has to come off the books, and it's going to come off the books for the amount that is the face amount of the intercompany bonds that were purchased by P from a third party, but were S's bonds. So I'm going to take a look at that down below where we have basically this was the original 190 was purchased, and then P purchased 76,000 of them from a third party. So we're going to have to, of this bonds payable of the 190,000, we're going to have to take off the intercompany portion, which is that 76,000. Then we have the premium. So the premium's on the books here at the 4,560. We need to take off the premium that's related to the intercompany portion of the premium, which we calculated in a prior presentation or a prior component calculation here at the 1,842. So we're going to have to take out that 1,842, the portion of the premium that is for the intercompany transaction. Then we have the credit on the investment in the bonds. That's what's currently on the books. So we have the investment in the bonds at the 74,860. That is all intercompany because these are S's bonds. So those therefore need to go off the books. So we're going to take them off the books with a credit. Then we have the interest income. Interest income and interest expense are going to be affected here. Notice they're not going to be equal and opposite, however, because of this weird transaction we had with purchasing it from the third party. How can we get those numbers? Well, one way to think about it is those transactions or journal entries we thought about at the beginning of this, thinking about, okay, what would be recorded on P's books with relation to this transaction? What would be recorded on S's books with relation to the interest for the transaction in the current period? And that's where we did that in a prior component. And we got this 6,270 was the interest that went on the books. Therefore, now we're going to take it off the books because this is the intercompany interest. And then we had the 5,776, which is the interest expense that went on the books as a debit. We're going to take it then off the books with a credit. So those are going to be those two items in practice. Note that we might be able to just basically drill down on the interest expense and interest income accounts as well, and see if we can find where those interest payments came from, break out a report by where they came from, and then be able to hopefully find equal and opposite components there as well. But in a book problem, you'll typically have to recalculate basically the interest component, or that could be one piece that you would have to take care of. Then we're going to take a look at this whole thing, the difference that we need, and allocate it out between the investment in S stock and the non-controlling interest in the net assets. So if we take a look at that, we're going to have the 76000 plus 1824 plus the 6270 minus the 74860 minus the 5776. That's going to give us this 3458, which we're going to have to allocate. That's the credit we need in order to be in balance. We're going to allocate it out 7525 times the 0.75, and that's going to be the 254 about. And then if we take that same amount, which was the 76000 plus the 1824 plus 6270 minus the 74860 minus the 5776, that's going to give us that amount times the 3458 times, then we will say the 0.25, and that's going to give us about the 865. So about the 865. Now you might be saying, okay, well, where did that amount, that 3458, come from? And notice that's going to be part of the difference when we calculated this constructive gain, the constructive gain of the 3952, the 3952. So in essence, if we take that 3952 and minus the amount that we had for that adjustment, the 3458, which is 34 minus the 3458, we're going to get the 494, which is one period's basically amortization of this constructive gain, right? Which is going to be this 3952 divided by, there was 8 periods that we're going to be dealing with, divided by 8. And, let me do that one more time. 3952 divided by 8 is going to be that 494. So basically that's going to be the component of this difference. So you can mull that over and see if you can, think about this constructive gain and how the transactions differ when it goes through that third party, and how we're basically allocating this constructive gain. You'll note that you have the component here that's going to be included in this transaction. You'll result in this difference, and we also took it into consideration when we did our first reconciling entry, because when we looked at that adjusting entry worksheet for that first reconciliation, we had the amortization of the constructive gain included in the table up in that component as well. Okay, so we're left with, then, if we take a look at our numbers, then we're going to say, all right, this one went down to 0, or we're at 1. I'm okay with that. Hopefully you are as well. It's a rounding error. And then the income from S is basically down to 0 as well. We've got the capital accounts are basically P's capital accounts matching the ending capital accounts, eliminating, in essence, S's capital accounts. Then we removed the balance sheet and income statement accounts related to the intercompany bonds. Not all of the bonds were removed here, but the intercompany portion was removed, as well as the intercompany portion of the premium, and the intercompany portion of the investment in the bonds has been removed. Then we had to remove the interest, income, and expense related to the intercompany portion of the bonds, and then record the effect that's going to be on the investment in S and the non-controlling interest as well, with regards to that basically the gain calculation, or the difference that's going to be a result of the purchase from the third party. So that's going to be it.